Welcome back. In our previous session, we explored journalizing transaction, which is the first step in the accounting cycle. But what happens next? How do we organize and classify these journal entries to ensure accurate financial reporting? That is where posting and the ledger come in. Why is this important? Posting transactions to the ledger helps businesses keep their financial records organized, accurate, and easy to track. It is like sorting files in a cabinet. Each account gets its own section, making it simple to see balances and analyze financial health. What we will cover in this session? Well, we will cover the definition and importance of posting, the general ledger and its structure, how T accounts help summarize transactions, the step by step process of posting journal entries, and some common mistakes and how to avoid them. By the end of this session, you will be able to confidently post transactions into the ledger and understand how financial data flows through an organization. Let's get started. Once transactions are recorded in the journal, the next step is to organize them systematically. This process ensures that financial information is properly classified and can be easily retrieved when needed. Posting plays a key role in keeping track of a business's financial activities, helping to maintain accurate account balances and ensuring the reliability of financial statements. By transferring transactions from the journal to the ledger, businesses gain a clearer picture of their financial position, making it easier to analyze financial performance and make informed decisions. In the next section, we will go through the detailed steps involved in posting transactions to the ledger and how it contributes to the financial reporting. Let's dive in. Now that we understand the importance of organizing financial records, let's talk about posting, which is the process of transferring recorded transaction from the journal to the ledger. Posting allows businesses to classify transactions correctly, ensuring that all financial activities are recorded under the appropriate accounts. To put it simply, let's compare the journal and the ledger. The journal is the first record of a financial transaction, which is organized chronologically. The ledger is where these transactions are categorized into different accounts for systematic classification. Think of a journal as your diary, where every financial event is recorded in sequence, and the ledger as a filing system, where transactions are sorted and grouped into their respective categories. In the next section, we will explore the step by step process of posting journal entries into the ledger and how this ensures accurate financial reporting. Let's move forward. The general ledger is the backbone of an accounting system. It serves as the main book where all accounts are maintained, helping businesses track and categorize their financial activities. Each account, such as cash, sales, or expenses, is represented using T accounts within the ledger, allowing for clear visualization of financial changes. There are two main types of ledgers: one, the general ledger, and two, the subsidiary ledger. The general ledger records all business transactions sorted by accounts. It provides a summarized view of a company's financial health. The subsidiary ledger, on the other hand, offers more detailed information for specific accounts. For example, instead of just having a single accounts receivable entry, a subsidiary ledger tracks individual customer who owe you money. By maintaining an organized general ledger, Businesses can ensure accuracy in financial reporting, making it easier to prepare financial statements and analyze their financial position. In the next section, we will dive deeper into how posting transactions into the ledger works. Stay tuned. Now that we understand the role of the general ledger, let's go through the steps of posting a transaction into the ledger. Every financial transaction follows a structured process to ensure accuracy and proper classification. Here are the key steps involved in posting a transaction. Step 1. Identify the journal entry to be posted. First, we need to locate the journal entry that needs to be transferred to the ledger. This entry contains the debit and credit accounts along with the amounts recorded. Step 2. Locate the corresponding account in the ledger. Find the appropriate account in the ledger where the transactions should be posted. For example, if the transaction involves cash and sales, you need to find both the cash and the sales account. Step 3. Post the debit and credit amounts in the correct columns of the T account. Once the correct ledger accounts are found, record the debit in the left column and the credit in the right column of the T account. This step ensures proper classification of transactions. Step 4. Update the account balance after each entry. After posting the transaction, adjust the running balance of the account. This helps track the updated financial position after every transaction. Step 5. Write the reference number from the journal to the ledger for tracking. Lastly, add the reference number from the journal to the ledger to maintain a clear audit trail. This ensures easy tracking and verification of transactions. By following these steps, businesses can maintain accurate financial records and ensure that their transactions are properly classified. Next, we will look at some examples of how transactions are posted into the ledger using T accounts. Now, let's take a look at an example of how we post a journal entry to the general ledger using T accounts. Let's have this transaction. A company purchases office supplies for $500 cash on January 1, 2025. Here is the journal entry for this transaction. Supplies account is debited by $500 and cash account is credited by $500. Now, to post this to the ledger, we take the amounts from the journal entry and transfer them to the respective T accounts. Step 1. We need to locate the affected accounts. The accounts involved here are supplies and cash. Step 2. Post the debit to the supplies account. Since supplies is increasing, we record $500 on the debit side of the supplies T account. Step 3. Post the credit to the cash account. Since cash is decreasing, we record $500 on the credit side of the cash T account. Step 4. Ensure proper formatting. The right side of T account is always credit and the left side is always a debit. By following this process, businesses can accurately track financial transactions and maintain organized and structured financial records. Next, we will discuss how D accounts help summarize transactions and how they link to financial statements. Now, let us apply what we have learned by analyzing a real world scenario involving multiple transactions and their postings in the ledger. Let's have the following scenario. A small business performs the following transactions in January. On January 5, they received a $1,000 loan from the bank. This means the cash account increases, which debits $1,000, and the loans payable account also increases, crediting $1,000. On January 10, purchased $500 worth of office supplies in cash. which increases the supplies account, debiting it by $500, but decreases cash, crediting $500. On January 15, they paid $300 for rent. This is an expense, so we record it under rent expense, debiting $300 and reducing cash, crediting $300. For each transaction, we move the amounts from the journal to the T accounts in the general ledger. The cash account is updated for all transactions, reflecting deposits and withdrawals. The supplies account records the increase from the purchase. The loans payable account reflects the liability from borrowing funds. The rent expense account captures the cost of rent for the period. This case study demonstrates how businesses keep track of their financial records efficiently by posting journal entries to the ledger. Now, let's focus on the process of transferring the transactions from the journal to the ledger, also known as the posting. Step 1. Identify the journal entry. Each financial transaction is first recorded in the journal in chronological order. In our case study, we have a loan received on January 5, a purchase of office supplies on January 10, and rent payment on January 15. Step 2. Locate the corresponding ledger accounts. Next, we identify the specific ledger accounts that are affected by these transactions: cash account, loans payable account, supplies account, and rents expense account. Step 3. Transfer each entry to the correct ledger account. Now, let's transfer each transaction. For the January 5 loan, the cash account is debited by $1,000. This means that cash increased. The loans payable account is credited by $1,000, which represents the liability. For the January 10 purchase, the supplies account is debited by $500, which means the supplies increased. The cash account is credited by $500, meaning cash decreased. For the January 15 rent payment, the rent expense account is debited by $300, which represents an expense. The cash account is credited by $300, which means that cash decreases as rent is paid. Step 4. Each time a transaction is posted, the balance of the affected account is updated. For example, the cash account initially increased with the loans but later decreased with expenses. The supplies and rent expense account reflect their respective transactions. The loans payable account now shows an outstanding balance of $1,000. Why is this process important? This process is important because of three factors. One, it ensures financial accuracy. Two, creates an organized records. And three, prepare financial statements. By following these steps, businesses maintain structured and reliable financial records. Now that we have posted each transactions to the general ledger, let's take a look at how they are summarized in the accounting equation. Step 1. Understanding the accounting equation. The accounting equation states that assets is equal to liabilities plus the equity. This will ensure that all transactions are properly classified and balanced. Step 2. Summarizing account balances. Now, let's summarize the ending balances of each account. Assets. Cash. After receiving $1,000 from the loan and spending $500 on supplies and $300 on rent, the remaining balance is now $200. For supplies, the purchase of supplies added $500 to this account. For the liabilities, loans payable, still the business still owes $1,000 from the bank loan. For the equity, this account reflects an expense of negative $300, which reduces equity. Step 3. Verifying the balance. Let's check if the accounting equation holds. Assets, which is 200 plus 500, is equals to the liabilities, which is 1000, plus the equity of negative 300, in which it's both shows 700 is equal to 700. Since both sides of the equation are equal, we confirm that our transactions were posted correctly. The importance of balancing the equation includes the following. One, it ensures the transactions were recorded accurately. Two, helps businesses track their financial position at any given time. Three, forms the foundation for financial statements like the balance sheet. By maintaining a well organized ledger, businesses can easily prepare financial reports and make informed decisions. Now that we have covered how to post transactions in the general ledger, let's take a moment to discuss why posting is important in accounting. Why is posting important? Posting plays a crucial role in financial management because 1. It ensures accurate financial records, 2. Helps in preparing financial statements, 3. Provides a clear picture of account balances, and 4. Allows tracking of business performance. By posting transactions correctly, businesses maintains reliable records. The general ledger serves as the foundation for the balance sheet and the income statement. It allows businesses to track their assets, liabilities, and equity effectively. With an updated ledger, management can make informed financial decisions. Even with a proper understanding of posting, mistakes can still happen. Let's go over some common errors and how to prevent them. 1. Posting to the wrong account. How to prevent it? Double check account classification before transferring journals. 2. Omitting transactions. Cross check journal entries with the ledger to ensure nothing is missed. And lastly, incorrect debit or credit placement. Follow the accounting equation properly to maintain accuracy. Proper posting ensures that a business maintains organized and transparent financial records. By avoiding these common mistakes, we can ensure that the financial data remains reliable and useful for our decision making. Now that we have completed our discussion on posting and the ledger, you should have a clear understanding of how transactions move from the journal to the general ledger. This process ensures that all financial activities are well organized and properly recorded. But what comes next? The next step in the accounting cycle is to prepare the trial balance and finally our financial statements. In our next session, we will cover the trial balance, what it is, and why it is essential for error detection, and the financial statements on how businesses summarize the trial balance using the income statement, balance sheet, and the cash flow statement. This step is crucial because it helps verify whether our debits and credits are in balance before preparing formal reports. So stay tuned for our next lesson where we will dive into the process of preparing and analyzing the trial balance and financial statements. Great job! In this session, we covered some essential concepts in posting and the ledger. Let's quickly recap what we have learned. 1. The purpose of posting in accounting, where we explored why transferring transactions from the journal to the ledger is crucial for maintaining accurate financial records. 2. How the general ledger works. We discuss its role as the main record keeping book where accounts are classified systematically. Using T accounts for transaction tracking, we saw how T accounts visually represent debits and credits, helping businesses track financial activities efficiently. And lastly, common posting mistakes and how to avoid them. Mistakes like posting to the wrong account, omitting transactions, or placing amount in the incorrect column can be costly. But with careful verification and attention to the accounting equation, these errors can be prevented. By mastering this concept, you are one step closer to understanding the full accounting cycle. In our next session, we will explore trial balance and financial statements. This is where we check if our debits and credits are balanced and prepare financial reports that provide insights into a company's financial health. So stay tuned, and I'll see you in our last session.